Greetings, everyone. Thanks once again for joining us. This is Greg for Teslafaninsight. I wanted to do a brief show today addressing what we saw from earnings from Tesla yesterday. Now, please remember to like and subscribe. As you know, I actually targeted $200 a share by the beginning of February, and you're now seeing why. First of all, obviously, Tesla delivered good, not great earnings. We already knew what those earnings were going to be because they announced a production number, and all you had to do to figure out the production and likely earnings number is just multiply 60,000 per vehicle times 405,000 vehicles equals your revenue number. So those numbers were already all known, and therefore the stock was moving prior to earnings. So the big question that came up was, what's next? Well, the answer is sort of twofold. Number one, there's this discussion of growth. And then number two, there's something I call Tesla's secret weapon, which you might want to stick around for. So the issue that's going on right now is Silicon Valley has a process. Probably 3 to 5% of the employees at these companies, including Tesla, are actually contractors. And what happens is that if we're going to have a really bad quarter, you fire all the contractors, and then you can kind of make your numbers and still look good. Well, what's interesting about what's going on right now is if you fire the contractors first, you're good, in theory, if it's a tough quarter. If you end up firing employees, that shows that things are really bad and not looking that great, hence the fact that you had to fire employees rather than just the contractors. So as part of that game, it tells us that Amazon, Google, Microsoft, all these companies are terminating people because serious structural growth-related issues, and therefore they can make their numbers without the business necessarily growing because they just cut heads. Now, why is all this related to Tesla? Well, the first item is that Tesla is still growing. So Elon has given out the 50% number. He's given out a 1.8 million target for the year for sure, but he thinks that they can get to 2 million vehicles. Now, all the numbers that he presented represents growth from where Tesla is currently, because it's a 1.3 million vehicle per year entity. So one of the issues that's going on is A, Tesla isn't firing its contractors, and B, it's not firing employees either. And C, what this tells us is that this sucker is still growing. So one of the games of the Valley or of Wall Street and large investors is they're buying growth. So what do we really want to see? We don't want to see Tesla up another 30 points in the next few days. What we need or want is Tesla up 100 points in the next few days. Ain't going to happen. I think we see a nice bump up heading for 200, but I don't see 400 in the next few weeks, but I think it's available. So I want to drag you into a strange zone as a lesson on investing and trading. And that zone is something that I call S&P and S&P related entities. So let's imagine we have a pool of cash, right? And that pool of capital is extremely large. The people who make money from managing that pool of capital are large money managers. And so they have mandates for putting capital to work. One of the games that's played is there are all these labels that you can place on different companies. So one of them is called, let's say, small cap growth. So what that means is small capitalization companies, usually below $1 billion, more like 500 million. And if we look at growth, those entities are likely to grow because they're actually kind of small. They could be in one part of the country growing to the next part of the country, one part of the world growing to the rest of the world. You get my drift. So the beauty of small cap growth is size of company can accelerate quickly and people can make a lot of money. The problem with that, though, is safety. So what people are looking for is, how can I grow shares that we've placed into a company, but they're large enough so that we know they're not going out of business. And so this is where we move into large funds putting money in into large companies only. So, one of the other examples of why you might choose, or the large funds might choose, the larger companies, is that the larger the company, the less impact the money that they put in has. So if you're, let's say, CalPERS or a large retirement entity anywhere in the globe, if you put money in, you don't want to put 10, 20, 30 million at a time. You have to put in 1 to 500, $1 billion. When you deal with the big cap growth companies, putting in $1 billion is no biggie. It doesn't move the stock price. When you put $1 billion into a company that's got a 500 million market cap, you're screwed, because all of a sudden you change everything about the company by your investment. And so therefore, you have most of the large funds focusing on what's called big cap growth or big capitalization growth companies. So we're now stuck with half the big money out there having to target the same sector. So the next question is, well, what happens if we have to go big cap growth? We've got to choose the companies that are still growing that are big cap. So what this then means is that if your company ain't growing and you're big cap and you're shrinking, your stock price isn't going to grow, your earnings isn't going to grow, so therefore it's a bad place for us to put our money. So hence, this is me dragging you through a long discussion at how we arrive at Tesla, and the numbers being perhaps an A, maybe even A plus that we just saw for large entities that need to put capital to work. And why? Because there's a competition between all of the big cap / tech growth companies out there for who deserves the capital, because they're going to hand out great returns. And so what we're ending up with here is we're kind of landing on a limited number of companies. There are certain companies that are down, like a Microsoft, Amazon, those guys. They'll do fine over time, but temporarily they're really not growing. So what we now have happening is that capital, as it comes in monthly from the big pension funds, are being directed towards Tesla. And that is kind of strange. Why is that strange? Well, think about it. Tesla used to do 100% per year stock growth a year or two ago. And I know that a lot of you enjoyed some real big boost to your portfolios in the process. But guess what? In a low or no growth environment where other big cap entities are sucking wind, the response is, hey, we ain't happy with Tesla's 30 to 50% growth for the year that they're forecasting. But guess what? 30 to 50% beats the heck out of a donut or even a shrinking company. So therefore, we end up with the screens for companies to invest in by large institutions being limited in the number of firms that are growing profitably. And that's how we end up with a whole bunch of targets going right at Tesla. And so as a result, we get nice bump in Tesla's value as these growth-oriented entities know one place they can put their cash and get ROI, return on investment, and they can't get it elsewhere. So this was the reason why I predicted a Tesla stock price heading for 200 by the middle of next week, because once the analysts give green light to these firms, they can dollar cost average into Tesla because they know they're going to get growth. The one other note I wanted to give you is that there's a concept in investing called nobody ever got fired by buying IBM. Well, the logic behind that is real simple. when you're dealing with very big companies not going out of business that are growing, they may not be the prettiest girl at the ball, but they have all these beautiful characteristics where if in fact you have Tesla in your portfolio and your client that gave you the money to invest says to you, what's in the portfolio? And you say, oh, Tesla's in there. And they're going to say, why you got Tesla in there? And they're like, because one, they got plenty of cash on the balance sheet, not going out of business. Two, they're growing. Granted, let's say it's 30 to 50% this year versus the normal 100% we'd like to see. Number three, we ain't got no better options for those kind of statistics. So therefore, four, it's a great place for your money to be for the next 1, 2, 3, 4 years versus other options on the table. And if and when those other options like a Microsoft, like a Google, etc., right the ship in their direction, that's when we'll go ahead and switch over to them. So what this therefore means is that without Tesla delivering barnstorming numbers of a year or two ago, they end up delivering some terrific numbers. And terrific relative to competitors gives Tesla access to all that capital that's rolling in by these institutions. And they can justify it because of the growth being experienced. Just a reminder again, think about all the layoffs that have happened at the big firms. And note, Tesla did a little bit of trimming, but they're not laying people off. And so this is part of the metrics of assessing whether or not it's a great place to place money. So congratulations to Elon and Tesla. The secret weapon is working in terms of money moving into the stock. And we look forward to more of it happening over the next few weeks as firms come to grips with the fact that Tesla has a business and a situation that's doing extremely well for growth while others don't. So therefore, Tesla gets the love in terms of the cash inbound. It's not permanent, as I described, but for now, it makes them the king of the hill in this space where the largest amount of money is being invested. So we look forward to your comments on this. This is Greg for Teslafaninsight. Tschüss, au revoir, lehitrot, choda hafez, zdravstvuyte, ni hao ma, konbanwa Japanese. And our health tip today is a reminder you need to do 25 leg lifts on both legs today before you get rolling into your day as a way to prevent knee issues and operations in the future. Hope you have a great day. Look forward to your comments. And let's go Tesla.